In this video, guys, let's look at the double hit stop method. Stay tuned. Hey traders, warm welcome to you. Right, so there's an alternative to the traditional tag and stop out method that most people use in trading, and that kind of probably ticks the boxes and is the best way of using it for most traders. This is something to consider if you're a little bit more advanced and you have a certain strategy or a certain approach that just needs a little bit more room to breathe. There's a little bit of flexibility. This is kind of the double hit stop method. So with traditional stops, of course, you've got your stop at a key level. If it comes up, and imagine this level is, let's just call it $100. If you imagine it's some sort of equity, it comes up. As soon as it tags that level, your order gets filled, bang, you get stopped out at the next available price. It's just a trigger to say, hey, this person wants to come out of his trade. It's in a short trade, it's a long stop, it's a buy stop, should I say. Hits the level, comes out. You know how the stop works. So the double hit stop method is basically saying, right, I don't want to do that. I want to use that as kind of the start of a timer. So in other words, hey, when the price hits my stop level or breaches the stop level, I start the clock. And this is where you can become flexible and play the game with it. Before we get kind of into that, let's talk about why you want to use it first. So you want to use it under conditions where if the market's very choppy, it's very kind of darting around in levels, and you know it has a tendency to kind of flash through levels and come back, and that's just its theme, that's the way it trades. You know, using a stop, a traditional stop, might be detrimental. You might be constantly getting pinged out of things on a little bit of noise. Maybe the market's a little bit less liquid, maybe it does this in the mornings or whatever it is, and then the kind of market goes back. So one way of kind of combating that is a wider stop. But then you don't have a wider stop because you're still in the same scenario. It just means that you're further away from the kind of pinging. So one thing you can consider is this type of approach, which is, hey, you know what, I'm not going to automatically cut the position. I'm going to give it a window of time. So let's say you're kind of a swing trader. That window of time might be 60 minutes. If you're a day trader, it might be 5 minutes. In other words, what you're saying is this. You're saying price must touch your stop level twice or more, or be above it if we're talking long, in a time period. So let's put that in kind of plain English. This scenario here, number one, price touches 100 under normal stop conditions, we're out of the trade. This scenario gives us 1 hour for the price to come back below it. If it happens to be above it, or if it touches it again and goes through it again, we're out. But in this case, it doesn't. It's touched it once, it's come back, the hour's up, the stop isn't triggered. In scenario two, same thing happens, it touches it there, our hour countdown starts. However, after an hour, it comes up and it's touched it again, and we are out of the position. We've basically given it chance to just wick and touch it and come away, and it hasn't. Now, before we go into 3 and 4, you can see the downside of this is that if it goes rip straight through your level, you've got an hour of basically pain potentially, you don't know where it goes. So your risk is a little bit uncapped, it's a little bit exposed. Now, I guess you could add a little hybrid model to this and go, right, you know what, I'm going to put a stop, a kind of worst case scenario stop even higher. Or you could kind of say, well, what's the worst could happen in an hour, and kind of judge it and adjust your position size to suit. Remember, guys, it's not the end of the world to trade without a stop. That's how a lot of people trade, but they manage that risk with position size. No one position is going to completely clean them out. So this scenario here, you've been stopped out. In this one here, we've got a similar type of thing, but this is the one that rips up and up and up. So your hour window's up, it's had time to come out, it hasn't. You're going to get pulled out. Here's where your exit's going to be. And of course, that's a lot more than the stop loss you planned on coming out at. But there's never, you know, it's not holy grail here, guys. The advantage of this is if the market does kind of do this or even this, you know, it rips right through, little spike, which is, you know, some markets like to do this, comes back within that hour window and starts to trade below it, then you could, because it hasn't basically closed above it in the hour window, it hasn't come back and been above it, you've kind of given yourself the room for it to ping back and forth and a little bit of noise. And that's the advantage of it. You are saying, hey, I'm not going to get pinged out on noise. But the disadvantage, of course, is the market could just go on and on and on and on, and you end up getting super huge slippage on your stop. So sometimes it can be difficult to judge how much risk to place on the trade. But it's something to consider. It's maybe something to consider for a small batch. So let's say you split your trade into quarters, and you've got a quarter left. Imagine you've got a quarter left, then the risk isn't that great. And let's say this is more of a trailing stop. Let's imagine the price has come all the way down and you kind of put your trading stop there. Rather than having a trading stop just as a tag, when you can afford to give it a bit more room, then you can kind of do the double hit stop method and start the countdown of an hour or whatever it is, depending on the time frame, and say, right, it's hit my level, I give it an hour. If it hits it again in that price period or goes above it, I'm going to cut it. If it comes back, great, I'm still in the trade. So it's something to consider, guys, something else to maybe add to your risk management trading plan or arsenal. If you like this kind of stuff, guys, thumbs up, much appreciated, as it always is. And of course, your comments. What do you think about this? Take care. Bye-bye.